Let me ask you a question. Have you ever seen a major news announcement coming, watched the market explode in one direction, and suddenly felt like you had to be in the trade? You see the candles moving faster than ever. The price is breaking through levels you were watching, and your mind starts telling you, this is the opportunity I've been waiting for. So you enter. But just seconds later, the market suddenly reverses, your stop loss is hit, and before you can even understand what happened, the price moves in the direction you originally expected. Now you're sitting there thinking, how did I get it right and still lose? This is the trap of news trading. The market can move hundreds of points in a matter of seconds. It can create massive opportunities, but it can also expose every weakness in your psychology and risk management. Because during major news events, the market doesn't move the way you expect. It moves the way it wants. And if you don't understand what you're really facing, one news release can turn a perfectly planned trade into a devastating loss. So in this video, we are going to look at why news trading is far more dangerous than most traders realize, and why the biggest challenge isn't predicting the news, it's surviving what happens after it. And this is where the temptation begins. When major news is about to be released, the market can suddenly become incredibly active. A currency pair that has barely moved for hours can suddenly explode in seconds. Candles become larger, price moves faster, and the potential profit starts looking impossible to ignore. You watch the market move dozens of points in moments, and you start thinking, if I had entered just before that move, how much money would I have made? That thought is dangerous, because now you're no longer looking at the market objectively. You're looking at the money you could have made. And the bigger the movement becomes, the stronger the temptation becomes. You start believing that you need to catch the next move, so you enter before the news, you increase your position size, you risk more than usual. Not because your setup has improved, but because the market is moving faster. And speed can create the illusion of opportunity. The truth is, a huge price movement doesn't automatically mean it's a good trade. Sometimes the biggest moves are the most dangerous ones to chase, because by the time you see the opportunity, the market may already be moving too fast for you to control the risk. And that's when excitement quietly turns into impulsive trading. You stop asking whether the trade fits your plan and start asking how much money you could make if you're right. That is the moment news trading begins to control you.
And once the market starts moving that fast, your decision-making begins to change. Under normal conditions, you may have time to analyze the chart. You can wait for confirmation. You can think about your risk. You can ask yourself whether the trade actually fits your plan. But during major news, everything happens at once. The price suddenly jumps, candles expand, spreads can change, and the market starts moving faster than your emotions can process. That speed creates pressure. You feel like you have to act immediately, because if you wait even a few seconds, you might miss the entire move. And this is where rational thinking begins to disappear. You enter without confirmation. You chase the price after it has already moved. You increase your risk because you don't want to miss the opportunity. Then the market suddenly reverses, and now fear takes control. You want to close the trade immediately. You move your stop loss. You hesitate. You panic. All of this can happen within seconds. The problem isn't simply that the market is volatile. It's that extreme volatility creates an environment where your emotions are forced to make decisions before your logic has time to respond. And when your decisions are made under pressure, your trading plan becomes much easier to ignore. That's why volatility can be so dangerous. It doesn't just move the price faster. It can make you think faster, act faster, and make decisions you would never make in a calm market. And by the time you realize you've made an emotional decision, the market may already be moving against you. And even if you manage to enter the trade, there is another problem many traders don't fully understand. The price you see on your screen may not be the price you actually get. During major news events, the market can move so quickly that your order may be filled at a completely different price from the one you expected. You click to enter, but by the time the order reaches the market, price has already moved. That difference is called slippage, and during extreme volatility, it can become much larger than normal. The same thing can happen with your stop loss. You may place it at a specific level, believing that it will protect you there. But if the market moves through that level too quickly, your position may be closed at a worse price. Now the loss is larger than you expected. This is what makes news trading so dangerous. You can be right about the direction and still lose more than you planned. You can correctly predict the news, you can correctly predict the initial market reaction, and yet the speed of the market can still work against you. Because during major news, price doesn't always move smoothly from one level to another. It can jump, it can reverse, it can create a massive spike in one direction and then completely erase the move seconds later. That's why a trade that looks perfect on your chart can become completely different once the news is released. The market isn't always giving you the opportunity to enter at the price you planned. And when you don't understand that, you can mistake unpredictable execution for a bad strategy. Sometimes, the problem wasn't your analysis. The market simply moved faster than your order could keep up.
And this is where many traders become confused. They do the analysis, they study the economic data, they identify the direction they believe the market should move, they wait for the announcement, and then the trade still loses. At first, it feels impossible. You think, but my analysis was correct, and sometimes it was. The problem is that being right about the news does not guarantee that your trade will be profitable. The market may have already priced in the announcement before it is released. The actual result may be positive, but not positive enough compared to what the market expected. Or the market may initially move in one direction before completely reversing moments later. This is why news trading can be so frustrating. You can correctly understand the economic situation and still lose money because the market's reaction is completely different from your expectation. The market doesn't simply ask, is the news good or bad? It asks, was the news better or worse than what was already expected? And sometimes the news can be objectively good, but the price still falls. Or the news can look negative and the market still rises, because price is not reacting only to the news. It's reacting to expectations, positioning, liquidity, and the decisions of thousands of other market participants. So, a good analysis is not a guarantee. It is only one part of the trade, and when you forget that, you can become overconfident in your prediction and underestimate the risk of the reaction. In news trading, being right about the story doesn't always mean being right about the trade.
And after the news is released, the first move can look incredibly convincing. The market suddenly shoots upward, or it crashes lower. The candles become huge, and for a moment, it feels like the direction is obvious. This is where many traders make their biggest mistake. They chase the move. They see the market running, and they enter because they are afraid of missing out. But the first move is not always the real move. Sometimes it is simply the market reacting to the first wave of orders. The price can spike aggressively in one direction, only to reverse completely moments later. And if you enter at the top of that spike, you may be buying just before the market falls. If you sell after a massive drop, you may be selling just before the market reverses higher. Now you're trapped in a trade that you entered because of excitement, not because the opportunity actually matched your plan. The dangerous part is that the faster the market moves, the more convincing the move appears. Your brain tells you, "Don't wait. If I don't enter now, I'll miss it." But sometimes, waiting is exactly what protects you. You don't have to catch the first move. You don't have to be the first trader in the market, and you don't have to prove that you can predict the initial reaction. Because the first move can be the most emotional part of the entire event. The market may need time to reveal what it actually wants to do, and a trader who waits for clarity may miss the most exciting part of the move, but they may also avoid the most dangerous part. Because in news trading, the fastest opportunity is not always the best opportunity.
And this is why experienced traders often do something that feels completely wrong to beginners. They wait. They don't rush to enter the moment the news is released. They don't try to predict every tick, and they don't feel the need to catch the first move. Instead, they allow the market to react. They watch the initial volatility. They observe whether the first move is being accepted or rejected. They wait to see whether the price continues in the same direction or quickly reverses. Because the first reaction can be emotional. The market may spike higher, then suddenly collapse, or fall aggressively before recovering just as quickly. A professional trader understands that the first few moments can contain some of the most unpredictable price action of the entire event. So instead of asking, "How quickly can I get into this trade?" they ask, "What is the market actually showing me?" That small difference can completely change the way you trade news. Waiting allows the initial excitement to settle. It gives the market time to reveal whether the move has real strength or whether it was simply a temporary reaction. And yes, sometimes by waiting, you will miss the biggest part of the move. But that is the price of patience. You don't need to capture every opportunity. You only need to participate when the risk makes sense. Because the goal of a professional trader isn't to prove how quickly they can react. It's to make decisions when the market gives them enough information to make a calculated decision. Sometimes, the best trade after major news is the trade you don't take immediately. And even when you wait for the market to react, you still have to be careful. Because news
can create some of the most convincing false breakouts you'll ever see. The price breaks through a major resistance level. It looks powerful. The candle closes above the level, and suddenly it appears that the market has finally chosen its direction. So you enter, but moments later, the price falls back below the level. The breakout disappears, and the market begins moving in the opposite direction. This is a false breakout. During major news events, the sudden increase in volatility can push price through important levels simply because there is a massive imbalance between buyers and sellers. But that doesn't mean the breakout will continue. Sometimes the market breaks above resistance, triggers buy orders and stop losses, attracts traders who are afraid of missing the move, and then reverses. The same thing can happen when price breaks below support. It can look like the beginning of a powerful downtrend, only for the market to suddenly recover. And this is why trading the first breakout after news can be so dangerous. The movement may look like confirmation, but it may simply be the market collecting liquidity before moving in the opposite direction. A trader who enters because the breakout looks exciting can quickly find themselves trapped. This is why patience matters so much. You don't just want to see price break a level. You want to understand what happens after the break. Does the market hold above the level? Does it continue to attract buyers? Or does price quickly return back inside the range? Because sometimes the most convincing move in the market is the move designed to convince you to enter before it reverses.
And after everything we've discussed, the most important lesson about news trading becomes clear. You don't have to catch every move. You don't have to be in the market every time a major announcement is released. And you certainly don't have to risk your capital just because the market is moving fast. Because the market will always create another opportunity. But the capital you lose today may not be available tomorrow. This is where many traders make a dangerous mistake. They focus on the money they could make. They see a massive move and think, how much would I have made if I had entered? But a professional trader asks a different question. How much am I willing to lose if this move suddenly reverses? That question changes everything, because protecting your capital gives you the ability to continue trading. You can survive a losing trade. You can survive a difficult week. You can wait for the next opportunity. But when you risk too much trying to catch every move, one bad decision can damage your entire account. And the worst part is, the next opportunity will still come. The market doesn't care that you missed the previous move. It doesn't punish you for staying out. You don't need to chase the market to be successful. Sometimes the most profitable decision you make is the decision to protect your capital and walk away. Because trading is not about winning every opportunity. It's about surviving long enough to participate in the opportunities that truly fit your plan. The market will create thousands of moves. You only need a small number of good ones. And if protecting your capital means missing a move, then missing that move is not a failure. It's discipline.